Welcome to Gamma On, episode 8. We are in the thick of it. I'm Oliver Renick. I'm the lead anchor at the Schwab Network. And today we've got a really fun conversation as we're going to take a little bit of a pause, assess what we've learned so far, try and figure out where lines need to be blurred and which ones need to be carved out a little bit more distinctly. In writing, the way I learned it at Bloomberg, you always have a to be sure graph when you're writing a story. And in that to be sure paragraph, you're basically taking the main theme that you've had and offering the counterpoint. So today we're going to do something like that. I'm going to be joined by Kevin Green, alongside with me, our contributor on the Schwab Network, and our guest today is Devin Anderson, co-founder and CEO at Convexitas, a Chicago-based firm that specializes in volatility strategies. And Devin, it's great to see you here. You're the other half of Convexitas. We've got Zeb Francis on our show a lot. It's great to have you.
Yes, sir. Thanks for having me.
Pleasure. And you've got a really fascinating background that is very relevant to kind of understanding what happens on the ground, what happens on the decision-making tree of a big bank that is potentially being a major options market maker, dealer. Tell me about your background and kind of weave that into how you guys started Convexitas. Let's set the stage there.
Sure. So I worked at Deutsche Bank for 15 years in a variety of roles. Most of that time was in the flow facilitation business. Well, I should say about half of that time was in the flow facilitation business. So the business of taking large block orders, committing a price, you may or may not have certain market risks, which is exactly what we're going to talk about. The ways that you mitigate those, the ways that you lay it off, those, that was my life for that period of time. Then I actually moved on to the more structured part of the derivatives marketplace in the institutional world. But coming out of that, Zed and I just see this huge opportunity in wealth to bring the quality of strategies and the discretion and really the strategies and professionalism that you would only really find in institutions and bring that into the wealth channel with really world-class option strategies. So that took some really significant investments in operations and being able to take what you might do as an institution and bring it into wealth with that level of sophistication. But we've done it, and that was really the foundation of Convexitas. We looked around and said, there's a real space here to bring up the sophistication a couple clicks.
The word, I want to make sure that I understand it, facilitation. Break down that kind of Wall Street lingo for me. What does that mean when you're facilitating flows?
So the displayed liquidity, on your terminal, okay, it's no different for retail folks than it is for institutions. You look at some option and there's, 20 on the bid and 20 at the offer, right? If you're a big institution, you have 10 or 20,000 options to trade. It's not like the guy sits there and picks at it 20 at a time, right? He picks up the phone, he calls a bank, calls a market maker, and they make a market on the whole size. And now the client's done, right? That asset manager who's got 20,000 options to trade, his trade's done at a fixed price. And now it's just a question of what does the market maker do with this block of risk? And what happens after that point is it directly impacts everything you've been talking about on this series. So I've been able to watch the first 4 episodes.
Nice. We appreciate that.
So
love that. An educated man.
Yeah,
always welcome here.
So, I'm in a position to react kind of, to my experience, what actually goes on in the process, and then kind of contextualize some of these tools like the GEX index and some of the levels. But I also want to talk about, impact, right? It kind of has 3 dimensions. There's the amount you have to trade, there's the liquidity that you have available to trade it, and then there's the amount of time that you do it in, right? So it's 3 dimensions. On those first 4 episodes, I heard a lot about the size, right? Nothing about the available liquidity and a little bit about the time, right? So I think we kind of need to round that picture out.
Okay.
And then we also need to talk about the difference between what happens when a trade initially happens, what happens when that market maker makes a firm price for some asset managers or some investors' total size, and then how does that show up as market impact? And then how does the second half of the conversation is what is the market impact of the ongoing risk management, right? And those two things get a little muddled together sometimes, so I want to cleanly separate those, and then we can kind of take down each half of the discussion.
Give me some historical context first, and as I mentioned, my colleague Kevin Green's on the line with us. He's joining us, so we'll bring him in, and he's going to be chiming in along the way. The background from your time at Deutsche Bank and the progress within the options market since, the big volumes, kind of the COVID, I should say, I was going to say bomb that hit. That's not a good one. The kind of COVID revelation of staying at home and options trading that kind of brought this to the forefront of the world in some sense. Has that meaningfully changed what happens on the ground from your time, or were all these concepts under discussion?
Yeah, so
then
it's complicated, but the as you say, the big change of the market microstructure in the time that I came into this world in 2005 to now has been the part that matters to this audience has been this revolution in retail trading, particularly in very short-dated options, right? So that's for sure is the big trade. Now, let's say that would have happened right after the financial crisis instead of during COVID. Would it have changed our job? I mean, a little bit, but not much, right? What really has changed a lot is that since the financial crisis happened, we've had a big change in regulation. It means that banks take less risk, and you've had market-making firms, so the Susquehannas, Virtus, Wolverines, Citadel Securities of the world, right? The independent, less regulated market makers and broker dealers are now playing a far more significant role in providing liquidity when it was just really upstairs banks in that role previously. And those folks are interacting with that short-dated retail flow through internalizers and a bunch of different means, but they're interacting with that flow electronically. So that wouldn't really have changed the pieces that we're going to talk about. I think it's an interesting discussion about when it comes to the zero DT and the short dated options trading. Does that show up in a meaningful way in terms of the total amount of derivative exposure out there that could possibly push the market around? That's an interesting conversation. It goes in the ongoing risk management bucket rather than the initial facilitation bucket.
Which then is a little bit more live and more kind of, I guess, a little bit of game of ping pong that can happen. I mean, part of the reason we talk about this stuff is because it happened in a few specific examples, think like GameStop and meme stuff, where people realize like, okay, there are these forces out there where if pressured right, maybe we can kind of ride that wave with some of these big players. Do you believe there is an ability kind of for the average person to at least use this as a tool in their belt to better understand what's happening or better kind of tell the weather of the market?
Well, we'll just be clear on what this is.
And there I'm kind of talking about just like what we've talked about before, kind of the gamma exposure generally.
So, I mean, most of what I'm going to say today is that it matters far less than I think people are representing it. And I'm going to
that's the to be sure round.
And I'm going to give you some data to kind of to support that, but also more importantly some theory as to why. Right? Some of it's market structure and just some of it's some basic option stuff. But can it matter? Yes. I'll tell you where it has always mattered, and it's just not debatable, is in single stocks actually. So particularly mid cap and small cap single stocks where there's a lot of overwriting activity, a lot of people selling calls. So you don't see – we used to call this pinning. I mean, people still use the word pinning, but you can see it in single stocks when you get this dampening like sine wave going into the close on the intraday chart, right? So like the stock will literally go through a big round number, back down, and then in this kind of dampening wave, and then pin right on the strike. So we used to see it a lot. When I was on the sales desk, I saw it a lot in things like thinly traded REITs. Some guy's got a portfolio of REITs. He also wants to sell some calls for a little bit more income, but the size he's doing is probably a little too big, and every once in a while you get a pin, right? So it matters in single stocks. In my opinion, and I think the data that I'm going to share with you supports, very rarely matters in index. It's not impossible. But this isn't something that I think needs to be part of your daily process until the numbers get very, very extreme.
Okay.
And we'll talk about why that is.
And when you say extreme, are you talking about in terms of just notional exposure? Are you talking about a way in which they change, a rate of change?
Yeah, I'm talking about
when liquidity is low, perhaps.
I'm talking about the total exposure of GEX needs to be kind of at its extreme maximums before we even really need to start worrying about this.
Okay.
So, in terms of time, we'll talk a little bit. I did a little analysis on the history of GEX and its levels, but, GEX over the last 5 years at 24 billion of gamma exposure is its maximum, right? I mean, you're talking about an S&P futures market that averages 370 billion a day, right? So I don't want to get all the way there. I mean, it's more nuanced than that, but I definitely want to talk about kind of these, liquidity. It comes back to this thing I said first. It's total to trade, available liquidity, and time you have to do it in. And as you pull on those three things, the answer can change. But if you push the exposure fast enough, far enough, right? You can have a situation where it could matter potentially.
Does it depend on whether?
But we're talking about maybe once a year,
right?
Like this shouldn't be something you're staring at every day,
right? Well, a lot of people are thinking about it like on expiry by expiry. KG's got a question, but one real quick for you is moments when it does matter. Are those essentially? Are you thinking about matter in terms of like having big effect? Because we also kind of have talked about how more often than not, these forces actually generally kind of compress and are something that are more setting kind of guardrails for the market rather than these big off ramps.
So to that point, just to give you a little preview here, when I looked at the GEX numbers, I was actually surprised at how often it's positive. It's a positive number. Something like 90% of the time.
Sure, yeah.
And in the last, when I looked at the kind of tried to compare it to the intraday liquidity, in the last 2 months, it's been negative only a handful of times. And we're talking about extremely trivial sizes, less than a billion, right? So you're right. I think I have quibbles with the methodology that we'll talk about that they use to calculate GEX. But if I just took it on its face as truth for gamma exposure, it's more often than not, maybe 9 times more often than not, dampening volatility rather than contributing it.
Sure. And I think that's generally the way we've mostly thought about it. KG, chime in. Where are you at right now?
Yeah, I'm right there with him in some respects. I would say on an intraday basis, I think these the levels that we do highlight here, I think they do actually matter if you're doing some intraday trading, and you could see areas of support and resistance that's there. It's not so much the mechanics of it, but also the fact that there's obviously a little bit more of a following to these different levels. And there's definitely more than just gamma exposure or GEX, as he's kind of talking about, right? You have Vanna exposure, looking at vol exposure. You have charm, which is time exposure. You have all these other different factors that are kind of in place here. But I think when we're talking about do they matter or when they matter, and the fact that we usually are in like a positive gamma territory, right? Market net is going to be long melt up. We rarely have a scenario where we're in these negative gamma environments where it could actually induce aggressive selling over a very long period of time. It could actually be a couple of days here, but everybody has their own different methodologies and what works for them. But I think there's definitely another piece there that Devin's kind of highlighting, that it's not only just these where the exposure is on an open interest standpoint or from a volume standpoint, but also the time that it actually does take and the amount of force that it takes to really create a reaction here. So Devin, kind of going back to what we have been kind of highlighting, and I know you have a couple of things on your notes here. When you are looking at vol structure, because it seems like you don't. It seems like you have several different inputs, and rightfully so. That should be kind of how you have the structure. What are some of the vol inputs that you actually look at, or the structure inputs that you look at from an option standpoint to be able to help facilitate trades for either your clients or to structure positive trades to the upside or negative trades to the downside if you're looking at downside?
Well, I mean, I have to kind of separate facilitation from what we do now. I mean,
Sure, yeah.
Convexitas is an investment manager where we run a set of long vol strategies, basically tools for advisors that they can put in their portfolios, helps with liquidity. It's kind of smart on taxes. That's a buy side thing, right? In the facilitation seat, okay, which is kind of the context of what we're talking about here. What I should separate. When I say it matters, it doesn't matter. I'm talking about impact to the underlying market. Okay, it's like, is it impacting the S&P itself? Is it impacting some single stock, right? And I'm going to tell you that overwhelmingly the answer to that is no.
Right.
Okay, and like I said, we'll get there, but that's not the answer for volatilities and option prices themselves, right? So things like the $80 billion of derivative income product out there now are absolutely having an effect on option prices, on the surface itself, the price of options. So we're up at the level of option prices, not down at the level of the underlying. So there are having effects there, right? And kind of one of the fundamental precepts about what we do at Convexitas is that in order to qualify, if you're paying fees to a manager, what they should be doing is high quality options trading, which is about taking the biases that result in those options market and turning it into a strategy, right? So, KG, to answer your question, for sure, there are impacts in options prices. What I'm here to tell you is, I don't believe that there are meaningful impacts on certainly a daily resolution on the underlying at the index level. Right. So that's the difference. But I think kind of to tell the story, you've really got to talk about, I hear impact questions kind of they come in two forms. The first is someone has a big trade to do and it's going to impact the market now because they're doing a big trade. Right. And then it's this stuff. It's is the ongoing open interest having an effect? Right. And that when it comes to that initial execution, when you do this GEX-like calculation on volume, that's essentially what you're trying to get at, right? You're saying, well, based on what's traded today, what effects might be out there, okay? So I think it's worthwhile because in all of these conversations, not just yours, I mean, there's a lot of this is gamma affecting the market stuff out there.
It's become sort of the popularized way to think about options.
I never, or is the big asset manager or mutual fund trade affecting the market? I never, ever, ever hear the stuff I'm about to talk about. Okay. And it's kind of perplexing to me as someone who sat in a facilitation role that you never hear about this stuff. Okay. So
what are those main pillars?
Yeah. So when someone, if big asset manager who has a mutual fund, okay, and there's several of them, turns or defined outcome ETF provider, right, turns up to trade, let's say they had a caller on and the market's now gone up, and the call's in the money by a lot, okay? And so they've got a really big number, 12 billion of delta that's got to trade, okay? So to roll their caller from their old one that has an in-the-money call, to roll that to a new caller that is centered around spot again, all right, there's going to be 12 billion delta to trade. Okay, that's not debate. You can just calculate it. That's a number. So it's not as if they just call up some dealer and they're like, hey, I got 12 billion delta to trade. What's your price? Right? Like, it doesn't work like that.
Okay.
When you have a couple 100 million of delta to trade, or maybe even 2 billion of delta to trade, the dealer will just make an outright market for you. And they'll say, we'll exchange the options with each other, and I'll just take that delta risk, and I'm going to price your option trade based off of where I can complete my hedge. Okay?
Okay.
So does that much make sense so far?
Let me ask it this way, because this is kind of what I was thinking earlier. Is the point here that this exchange, that this trade then, if you will, this delta cover basically, is happening at a level at which the market maker is not price insensitive? Because I think there's this point where the gamma stuff really starts to happen if the big player is price insensitive to where they're having to do something that maybe they were either
they're not price insensitive for
exactly.
Sure. Because you come to me with your call spread swap that I'm talking about. I'm going to be at risk on some amount of delta. I have to price the trade at the level where I can complete my hedge. Now, you got to remember, option markets are competitive, right? And the asset manager has a fiduciary duty to get the best possible price. So he's going to put a couple dealers in competition.
Sure.
Right? So you'd be amazed at how tight some of this stuff trades, actually, right? So, but they don't, when you get to the really big orders, the ones that get people's attention, the 12, 15 billion of delta on somebody's roll to trade, that's not what's going on. Okay.
They're not clamoring.
Yeah. They're not. No one's at risk on 12 billion delta outright that they have to trade in 5 minutes. Like it's just not how it works. There is a set of tools out there that they can use. There's a number of techniques that they can use to mitigate that. Okay. So one of which is this thing called the tied hedge exemption. So this is an exchange rule that says they ask you if you were the asset manager, Oliver, and I was the dealer, you and I can trade outright between each other. Okay, but you're going to give me the order. I'm going to notify the floor. I'm then going to go trade my hedge. Okay, and then as long as the options are still inside the bid ask, I'm going to present the hedge and the options to the floor before it goes on the tape. Okay. So you're still going to get your outright fill. Okay. But I'm going to be able to trade my delta, the thing that I'm at risk on, before it's presented to the floor, right? So before I potentially get run over on my execution of the hedge. So that's one rule. Okay. Never before have I heard anyone in this conversation talk about the tied hedge exemption. Now, this is one of the less popular ways to mitigate this risk, but it's out there. Another one is—
Why is that? Is that just because it's so kind of inside?
It's a little risky to pull off because if your option, if you still have to print the options inside the current NBBO, that's the exchange roll, which cannot happen, right? So you're taking some risk here that you would potentially have to further improve the price in order to actually get the trade on the tape. So this is exchange mechanic stuff. Okay. So the tied hedge exemption is just, but you never, again, my point is that I just never hear about it. It may not be the most popular thing, but it's certainly a tool that gets used. Another thing is you can trade over the counter first. Okay. So you can just call me and we can do a bilateral trade of my call or swap. Now I can go trade my delta in the market over a whole day if I wanted to. And then I'll adjust my option prices to where I get my hedge done. And now we've got an over the counter trade. Well, then there's a process called an exchange for physical, or actually I think in this context we'd call it an exchange for risk, but an exchange process that allows me to swap my over-the-counter contracts for listed contracts. So boom, my trade would just appear on the tape and it would look like an outright trade and people's hair would be on fire because they go, oh, look at all this huge risk that just hit the tape. But no one's trading anything. It was already traded before it ever went on the tape.
Will it still appear as the notional gamma exposure, like when we're looking at it?
Yeah, you'll see it in the volume. It'll look just like any other trade. If you were just looking at the tape, it'll look just like any other trade. Yeah. But actually, the whole thing is already traded.
It's already, right, I see. So we're thinking about it as this kind of big block of money that's got to move around or be—
The reality is it could have already all traded. Okay. If we went down the EFP road, right? Okay. And then the SIBO, quite smartly, in 2020, launched this thing called the DAC, the Delta at Close Order. Okay. So now all the defined outcome products actually use this. In this case, you and I agree to a trade. We agree on our whatever our role is. We agree on a delta to adjust our prices and an initial reference of where the market was when we agreed on our trade. And then we just delta adjust the prices to whatever the close happens to be. So I get my hedge done on the close, and then we adjust the option prices by however the market moves between the time that we agreed to, wherever we agreed to, and where the close happened to be. Now, the advantage to that is that the close is hyper liquid, and in the case of the X&P, you have this 500 stock closing auction process, right? So, and if there's imbalances, they get published, people come in and provide liquidity. You get lots and lots of liquidity out of the close. So the DAC actually solves this problem too. Okay. But it's a little funny to me that I'm always hearing about such and such has X to trade on their roll, but the reality is they aren't considering how this market, how the actual underlying delta hedge actually is going to get executed. It may well be executed with one of these techniques or one of these exchange rules that largely or completely mitigates the impact that it would have had. Okay. All right.
It seems like that then is something that would be easily missed from the outsider perspective who's just looking at this and assuming that they're going to have to kind of go and do all this on the open market for the same prices that we see on all the screens. But basically, there's a lot of different ways and arrangements for—
Now, if you buy market data, you get a richer like flags and you get
Sure.
richer information.
Right. You can get more insight on actually the motive behind certain.
Yeah. Well, you can tell like if an exemption was used, for example.
Yeah.
But to someone just like watching the volume intraday, through their like custodial interface, you're getting none of this, right?
KG, I know, wanted to follow up on those 3 points you gave, Kevin.
Yeah, and I think that's actually a really good point that Devin's kind of pointing out here. But I'll go on the other side of that, Devin, and say, does the flows on the tape have enough impact to encourage other traders to follow, right? And I think that's one of the key areas that I kind of focus on. I think you're kind of alluding to the JP Morgan equity collar that's put on, right, on a quarterly basis, or even your QILD on the NDX side of it. But do you think just the volume hitting the tape itself is enough to wake up options traders, equity traders, what have you, but wake up those traders, and that's where you could see.
Yes, so you're asking is there some like George Soros like reflexivity
Exactly.
that just because there's this information here,
too, like price, we're all watching the same moving average.
Look, we don't see it. I don't see it. Like there's been plenty of times where we know that one of these rolls is out there and we're watching it kind of in the last few hours of the day, and like we just don't see it, right? And I think it's because I don't know how they execute. I know all those guys from when I was at Deutsche Bank. It's been a long time since I covered them, but those products were fractions of what they were now at that time. I don't know what they're doing to execute it, but they're clearly managing it well because they're not moving the market when they have a big roll to trade.
Okay,
or they're not moving the underlying S&P.
When we see ticks up here and there intraday, are we projecting? You think as traders?
I think so. I mean, look, we're talking when we actually get into some of these impact estimates. I mean, we're talking about sub 1% basis point kind of moves, like things measured in basis points, not things measured in hundreds of basis points. So I think it's easy to ascribe a narrative to this stuff that you can't really quantitatively back up.
The other thing too, I would say, is that the way I think about it a lot, kind of since we have even started this, to be honest, is that I view it as there is just exposure, gamma exposure, as an output like anything else, where there's all these trades happening and we can calculate these numbers, and that is simply an output basically of what's happening. When it becomes an input is when it gets a lot more murky, which is on those very limited occasions, basically what you're describing.
Yes.
Whereas mostly I kind of see them as the guardrails like we talked about, positive gamma, generally compression, generally the same things that cause stocks to generally go up over time already, to where it seems like this stuff becomes an input sometimes if the market's really going off those rails, which are oftentimes a product of exogenous forces, outside things happening.
Right. Well, that's the whole thing. There can be other things.
Maybe, how it's happening, or one way in which there are people under pressure.
There could be a small hedge fund liquidating that you don't know about. There could be there can be a myriad of things. There could be a big blind program order on somebody's desk that they're out hedging in the futures because it was a blind block. Like, there could be a mutual fund that had a big redemption that day. Like, it can be all this stuff. I think when you spend time on an upstairs trading floor like at a bank, and you look around this essentially marketplace of different desks and different products, and you begin to understand what the ETF guys are doing all day, what the program guys are doing all day, what the cash guys are doing all day, what the synthetic equity and swap guys are doing all day. Like, and you begin to see how things can bubble up in one place and not the other. You're a little more reticent to kind of point at something like this to say that's what's moving the market. And by the way, I haven't even mentioned the fact that when you get one of these big block orders, you may just instantly lay part of it off. Okay, when we had a big block order on the desk, particularly in listed options, you have a handful of they're more customers than they are market makers, but a handful of people that you call and say, hey, I'm committed.
Share this risk.
I'm committed at this price. You just want some.
Sure.
And they take outright fills. So if I had 10,000.
That really hits the price insensitive point hard.
Right.
Because that distributes that risk quite a bit in a way that doesn't cause people to rush to suddenly
And for the
cover a
most part,
position.
you're distributing it to people who want it. Right?
Okay.
So they're definitely not in a hurry to go out and hedge something in the market, right? So
that seems like what a lot of it boils down to. What are the situations in which they have to become an price-insensitive buyer and do it in a hurry, which is very few. I want to make sure that you mentioned some impact estimates.
Yes, for sure.
Kind of what are we talking here?
So look, I mean, let's just talk about GEX a little bit and kind of what it is. So stuff like this has been around for 20 plus years. That's another thing I think you just got to get your mind around, right? Like, it's not that often that something that's 20 years old has a lot of information in it.
Okay.
Let's just be honest.
Okay.
So the initial impact of gamma-like models was I'm just going to assume all the calls. Well, I'm going to assume everything was traded with a delta hedger on one side, which is not the case. Okay, it's just de facto not the case for the reason that I just described. If somebody calls up with a big block order, I'm on the flow facilitation desk. Maybe the complex book needs to buy some tech calls for one of his complex products. He gets some. You lay off some to other broker dealer like customers. So what was a 10,000 lot order, now you're really only facilitating 6.
Will still show up on the bank's books.
Oh yeah.
So it'll okay, right.
Well, it'll show up in the open interest, right?
In the open interest.
So first of all, not everything is traded by a delta hedger for sure.
Okay.
Right. It assumes that call options are always sold by investors. Now that was a reasonable assumption 20 years ago. Okay, it's not the case anymore. I mean, the entirety of the zero DTE flow that's not the case, right? I mean, the zero DTE flow is really only 2 things: it's people buying calls in single stocks and selling put spreads for income in the index, right? I mean, that's all of that flow from a retail side. And then that's the other thing. It assumes that 100% of puts are bought by people who aren't delta hedging. I mean, that's just flat out not true anymore.
Fair.
There's 80 billion of derivative income product out there, right?
That's something we have talked about where you obviously don't know the motive behind a lot of what you see on the screen.
Right. And then finally that dealers precisely hedge to their delta, which is also not true. And we're going to talk about that with kind of the Vanna charm impacts. I think most people would be surprised to know that in a professional risk management system, you not only have your delta, but you have end of day delta and then probably 4 more deltas that make different assumptions. And depending on the book that you run and the risk that you have, almost no one is blindly hedging to a Black-Scholes delta. Like it just doesn't. That's not what happens.
Okay.
So kind of all 4 of these things are flawed.
Sure.
Now,
because a lot of what we're talking about is kind of theory, right? And in reality, these are where the holes kind of get filled in.
So then what comes along next is the next generation of these models was, I'm going to assume that actually only percentages of the calls are actually people selling them, right? So I'm going to go from 100% down to 60% or something like that.
Yep.
And then on the put side, I'm going to do the same thing. Right. So this in the second generation of this stuff, people started not assuming 100%.
Okay.
Then in the third generation of these models,
which is progress,
right? Then in the third generation of these models, people were actually taking where the prints went up and ascribing. If it printed closer to the offer, they'd say, "Oh, well, that option was bought." Right. And if it was printing closer to the bid, they'd say that option was sold. Right. So now you're actually dissecting the tape trade for trade and trying to put it in the right bucket of
more
which direction it is, right? And then then where we are now with this stuff is that you're doing that plus getting some of this meta information about order type off the tape and trying to incorporate that so you can make smarter guesses about who's delta hedging and who isn't.
Okay.
So I guess my point with all this stuff is, this GEX calculation and technology. It's fine for like a very rough idea.
Sure.
But it's 20 years old and 4 generations past.
Okay.
What the people you claim to be trading against, right? They've got 4 generations better than you.
Right.
Right.
Sure.
And in very high speed market access and very sophisticated models. So, I'm just kind of chipping away at this idea that there's information in here until the numbers become so big that you can't ignore them, right?
I get that. That's compelling. I would say the only thing that I do kind of sympathize a little bit with KG's point, because it's theory and it's kind of impossible to prove, but it does make sense to me logically, is that the explosion of activity among traders aware of this back and forth now is similar to like watching a line, basically, where it sounds like simple like ape math or logic, but it does ring true to me, which is that enough people can build that kind of reflexivity if now they start using it as an input, but still probably limited to those moments that are already like tail risk for the market on their own. The other second derivatives you mentioned, Vanna charm real quick. Thoughts on whether or not these are more useful in terms of kind of assessing what market makers have to do? Do you prefer to look at the time element? Do we need to shift then?
Yeah, so I mean, I probably feel the strongest about this stuff. It's just not a thing.
Okay.
Sorry.
In terms of what?
Okay.
Well, we know it exists, right? We
Okay.
know what.
So,
but as an input, you're
even
saying it's
even if we could agree on the amount of delta that has to hedge out there, okay,
which you've argued is very hard to actually
even if we
pinpoint.
could agree that there's a number out there, and we haven't even talked about impact yet. I want to get into those, but even if we could agree, we all know that tomorrow will be a new day. We know it's coming. It's not
Tomorrow
like
the sun will rise.
like-
Tom Hanks, Castaway.
I promise you, the guys at Citadel are smart enough to know that their delta is going to change tomorrow, right? So, like I told you, in any sophisticated risk system, there's delta, then they've got a second column, end of day delta. Promise you that delta is different than the one that they're looking at intraday.
Okay.
Because one, their positions are changing, and you need to know what's
So
happening.
we've already kind of got stale
But like,
data a little bit.
it's a different delta too.
Okay.
So it's not like you get to the end of the day and you hedged your Black-Scholes delta, then you come in the next morning, and because a day has passed, now you've just got a new delta you install.
Right,
Like
sure.
it's nowhere near that simple.
Yeah, it's a spectrum. It's all blending together, right? Like
Right.
their
And in
exposure.
terms of vol changes, okay, with changing your deltas, this concept. So that's a concept that has also been around forever. You know, in the professional community, we call it shadow delta and not charm. But
That's going to be in the title for the Shadow Delta.
but people have been adjusting their deltas for that stuff for 15 years. Like, I promise you that anyone that has a book big enough that where this matters is using not a Black-Scholes delta, but a delta that is adjusted for this stuff. So it's not as if there's going to be a lot of institutional flow from these things. Now, I'll tell you where those Greeks are not, these types of cross Greeks. I say they're cross Greeks because delta is the how an option changes with respect to the underlying.
Yeah.
Gamma is the rate at which the delta changes. Vega is how much the option price changes with respect to vol. Volga is the rate at which that changes. Right? Those are first and second order Greeks. These types of cross Greeks really matter in complex books. Okay. So if I had a derivative where spot would move and then the maturity changed, now we care about cross Greeks. Okay. So for example, the single most popular structured product in the entire world is the auto-callable, which we're not going to talk about. But when spot goes down, the auto-callable can essentially redeem early. Just accept that for me on face. I just want to do an example.
Okay.
When the spot goes down, the life of the auto-callable gets longer. Well, now I care about time a lot. Okay. So these higher order Greeks and these cross Greeks, these things matter, but not for plain vanilla options.
Sure.
Right. I mean, like it just. I'm sure there's people that would like to argue with me, but I'm telling you, you sit in the seat, you're not hedging to a Black-Scholes delta. So the impact of these things, I don't even really know how to quantify it.
Yeah.
Right.
Up to that point, though, because we got a short amount of time, though. The impact, you got a number, got a couple numbers.
So I mean,
on us?
here's the numbers for S&P.
Okay.
I don't think, you got to get your mind around this.
Yeah.
Over the last 5 years, average, mean, 370 billion a day. That's just the mean.
Yep.
Okay. On the slowest day of the last 5 years, 40 billion. On the busiest day of the last 5 years, 972 billion. Almost $1 trillion of notional traded. Okay.
S&P.
Right. In the last now here's another number. In the last 3 months, in the last 30 minutes alone. So a lot of times the counter arguments you get about this stuff is, well, but all this happens at the end of the day. I mean, I'm here to tell you that it doesn't. You don't just wait until the end of the day and trade your delta in a rush,
point.
right? But but I'll go with it. Okay. Last 30 minutes of the day, mean 50 billion. So on average, 50 billion just in the last 30 minutes, right? And as much as 100 billion. So basically 10% on a relatively reliable basis trades in the last 30 minutes versus all day.
Yep.
Okay. So now then go look at the GEX levels. Okay. A big GEX day is 10. The biggest in the last 3 months was 10. The biggest in the last 5 years was 24. So you're talking, when I went back and looked at the ratios, these GEX levels tend to around 17 to 18% of the traded notional value. And by the way, this is not special math. You literally can just get your Python. Any retail trader can do this. Just get your Python, get the Y Finance add-in, download a history, multiply futures volume
Yep.
times price times 50, which is the multiplier of the E-mini contract. The E-mini contract ticker is ES equals Y, right? And then add in the spiders. So these numbers are spiders plus the E-minis.
Got it. Okay.
Add in the spiders, which gives you about another 10% of liquidity, and you're going to get these same numbers. So like I have a hard time getting excited about, you guys had in one of the episodes I watched, you guys did a live demonstration, and it basically had, like 1 or 2 billion of it.
Right. Yeah.
I mean, you can trade 1 or 2 billion at sub 10 basis points of market impact.
Sure.
Right? And that's if you're in a hurry. Right? So again, we kind of come back to this thing. How much to trade, how much liquidity is there to do it, how much time do you have to do it? At these numbers, the sizes that you need to have really meaningful impact, we're talking about hundreds of basis points, which is the types of moves that are relevant to the people watching this. You're not a high-speed trader, most likely if you're watching the show. You're not there to scalp 10 handles.
Correct. Yep.
We've got to have meaningful,
you need moves.
Meaningful moves. In order for this dynamic to truly be generating, or somebody's big role to truly be generating, we're talking about much bigger numbers than what I see here.
Okay. Case well made. I think that it's basically the conclusion for me is that you have to have already some kind of outside force, basically, that's going to either pinch liquidity, really take people by surprise, kind of get those moments where maybe the exposure can tell you if the ice is going to be particularly slick or not. But
right,
there's
but
gotta
you can
be
have things
something
come
there
together.
already.
Right, the right macro comes together with a surprise announcement in the last 30 minutes of the day. And people getting caught surprised when the numbers happen to be big. Like you
have to have a lot of things that add up.
You need a lot of
together.
things to come together. I just don't believe it's something that is going to matter intraday. But I will also say on the single stock side, a lot of this can happen a lot easier.
Okay.
You can find these, like I said, kind of dampening sine wave like pins in mid and small cap names because again, it's all about those three things and there you had potentially more exposure but far less liquidity.
Yeah.
Right. So that's the framework I think you've got to look at the stuff in.
Great stuff. Love the perspective. You the man. Thanks a lot, Devin.
Happy to help.
Yeah, very cool.
Thanks for having
very
me.
nice to kind of get the to be sure as well, to kind of think about how some of these notions we kind of take for granted a little bit. We kind of we try to read everything that we can from the market. It's natural that we want to have kind of every tool in our belt, but there's a lot of things where you just don't know what's going on behind the scenes. You don't know what who's trading hands and for why and what other literal options they have. I think the point about laying off risk too is a really big one. Because it suggests it doesn't always have to be some like giant scrambling.
Well, that's right. I mean, 10,000 options hit the tape. If 9,000 of them were laid off to outright holders,
right,
it doesn't look any different on the
much
tape.
more diversified type of like participant. Then great stuff, KG. Thanks for the questions. Appreciate you as always. To Mr. Kevin Green, Devin Anderson, co-founder and CEO at Convexitas. Kevin Green, markets correspondent on the Schwab Network. Nice, good stuff. Good balance for us here. Always good to have it in a conversation about markets. Thanks for tuning in again on episode 8. Make sure that you subscribe on the YouTube channel, as well as, of course, on Spotify, where you can listen or watch. We will be there. I'm Oliver Renick. Thanks for tuning in.